Welcome, everyone. Thanks for joining us. In the chat, if you could please introduce yourself and let us know where you're joining from. We'd love to hear that. My name is Vincenza, and joining me today are my colleagues, Alicia and Christy Lynn. We are part of the Empowering Financial Wellness Program with Utah State University Extension. Alicia will be co-presenting with me, and Christy Lynn will be moderating the chat. So if you have any questions, please feel free to put them in the chat. We'll make sure we get to your questions. So today, this webinar is brought to you by Utah State University Extension in partnership with the Utah Department of Workforce Services. And today, we are going to cover some strategies for your finances, and we're going to talk about credit scores. We're really glad that you could join us today. So let's jump right in, and we're going to talk about what objectives we're going to cover today. So the first one being, we're going to talk about that mysterious number, that credit score, that coveted number. What are the factors? What makes that number? So we're going to dive deep into how do they come up with your credit score? And then the second one, you're looking at your credit score and you might be thinking, well, how can I improve my credit score? What can I do? So we're going to share with you some strategies to help you boost your credit score. And then lastly, being mindful and keeping in mind, what are things that you're doing every day with your money and your finances? And how do they affect your credit score? So giving you, again, some strategies to be thinking about. Some of the decisions that you make can positively or negatively affect your credit score. So we're going to talk about that as well. So let's start off with doing a quick poll. It's going to be a true or false, just to get a gauge for what you're thinking. There tend to be a lot of, let's call them myths with credit scores. So we're here to kind of bunk some of those or just reinforce some of those that you know to be true or not to be true, so that you're dealing with factual information. So let's go ahead and run that poll. Okay, there we go. So the first one, is it better for your credit score to be carrying a balance on your credit cards, or is it better for you to pay it off in full each month? So the question is, it's better for your credit score if you carry a balance on your credit card than if you pay it off in full. Do you think that's true or false? And the second question is, the most important factor that affects my credit score is paying my bills on time. Do you think that's true or false? And then the last question is, when you co-sign a credit card or a loan, the debt will show up on your credit report. Do we think that's true or false? Okay. So let's go into the first one. Here are the poll results. So the first question, is it better for your credit score to carry a balance than it is to pay it off? That is false. Paying off your credit card balance in full each billing period, if you can, is actually a good thing. It improves your score because it's showing that you're a responsible borrower. It will also lower your credit utilization ratio, which we'll get into later, which means how much of your available credit are you using? So it's not a bad thing. Sometimes people think that they need to just keep a little bit of balance on their credit card for that. They think that helps their score. And that's one of the myths out there. If you can pay it off, there's really no reason to carry a balance because you're going to be paying interest on it, right? If you have the money, it's better to just pay it off. Okay, next question. The most important factor that affects my credit score is paying my bills on time. True, true, true. That is so important. According to FICO scoring model, there are other scoring models. We'll get into that in just a few minutes. But FICO says paying your bills on time, when they do their scoring model, 35% of that is affecting your credit score. And it is the most influential of all of the factors that go into your credit score. Even one late payment. Some people think, it's just one late payment, but believe it or not, one late payment that's reported to the credit reporting bureaus can negatively affect your score. So most important thing, make sure we pay our bills on time. It's super important. And then the last question, when you co-sign a credit card or a loan, that debt goes onto your credit report. And that is true. They usually do appear. There may be some exceptions, but even though you're not the one that's making the payments, there is the whole reason why the person needed a cosigner is because they didn't have enough of a credit history or to be able to get a loan or credit card on their own. So you're their guarantee that that's going to get paid. So there is a possibility that you would have to pay off a loan or take over payments for what you co-signed. And so lenders want to know that, like, what's the possibility that you could be on the line for this debt? So the other thing to think about, if the person you've co-signed a loan or credit card for is not making their payments, that's going to negatively affect your credit score as well. That's going to show up on your credit report. So if you are going to co-sign, be very, very careful to make the right decision for you, knowing that worst case scenario, you'd be responsible for that debt. Okay, so let's move on to the first objective. And we said we would talk about credit scores. So what is a credit score? So credit score is that 3-digit number that reflects the likelihood to the lender or the creditor. How likely are you to repay your debts, your loans? So when most people talk about credit score, they're talking about the FICO because it's the brand that's most used by lenders. But it's not the only credit score that's on the market. There's also a score called the Vantage Score, which we'll get into. We're going to compare and contrast the differences. And generally speaking, the range for both scores, whether it's a Vantage Score or a FICO score, it's going to be somewhere between 300 and 850. There are some industry-specific scores, like, for example, what auto dealerships use, and that number can go up to 900. But again, that depends on who is pulling that credit score. And also another thing to keep in mind, that a credit score may vary depending on which bureau you pulled it from. If you pull your FICO score from Experian and you pull it from Equifax or TransUnion, you might have slightly different numbers because different things may be reported on those reports. You may have one credit card or loan that's being reported on Equifax that's not being reported on TransUnion. So that's one reason why you might see a difference in scores. And then a lot of times lenders will do what's called a merge, and they'll just take the information from all 3 of your credit reports and come up with one score. Again, sometimes lenders also have their own proprietary scoring models that's based on FICO. And depending on the version, there are always new versions of these scoring models that are being released. And maybe a bank is using a version from 5 years ago, even though the more current one is a different version. So that you may pull it and they may pull it and you might get different. Or depending from lender to lender, you might be going to different banks loan shopping, and they might get there might be a difference in those scores as well, because it depends on like what version of the score they're using. So a lot of people ask, what's a good credit score? People ask me, what's good? What's considered a good score? So what I can tell you is that as of October of last year, the average FICO score in America is at about 711. Now, whether it's good, bad, average, it really depends on the context in which they're being judged. For example, if you're trying to get a platinum credit card, a 740 might not be high enough. But if you're a first-time home buyer, for example, with decent down payment, a 740 score would actually be really, really good. And that could get you probably qualifying for some of the lowest mortgage rates. So again, just depends on how you're using the score, what it's being used for. So let's jump into what is the score? What are the factors that go into it? So remember, we said earlier that paying on time is the most important, because as you can see, it's the most influential factor in the FICO score model. The second most thing is, how much money do I owe? How much of my available credit is being used on my credit cards, for example? So just 65% of your score, which is the majority, is paying on time and how much you owe. The next section is credit history. That weighs about 15%. So they're going to look and see how long have you had credit? How long have you been using credit? Those accounts that have good history that you've had for a long time, those can really influence your score positively. And then we look at credit mix. They're going to look at, do you just have credit card debt? Do you also have installment loans? Do you have a mortgage? Do you have car loans? A lot of lenders like to see that you can handle different types of debts, not to say that you need to have all of them, but they like to see that this person can handle credit card debt, this person can handle installment loans that are the same every month, et cetera. And then the last factor is new credit. So they're going to look at how much new credit have you been applying for? And the whole reason why that's used in a scoring model is because research has shown to lenders that opening a lot of accounts in a short amount of time typically represents risk to the lender or creditor, especially for people who don't have a long credit history. So if you can avoid it, try not to open too many accounts at one time, better to stagger them. Every time you open a new account, it counts as an inquiry, and too many inquiries can negatively affect your score, and inquiries will stay in your credit report for up to 2 years. Of course, as time passes on, the longer time has passed, the less impactful that inquiry will be. With the exception if you're shopping for like a car loan or a mortgage and you have multiple inquiries in a short period of time, they're only supposed to count as one inquiry. Okay, so that's FICO score. Now let's look at the Vantage score. So Vantage score, the payment history is a little more influential. Now, if you pull a credit score and you're wondering, am I pulling a FICO or a Vantage score? If you're not sure, there's going to be some language on the report that says, probably in small writing, this is Vantage, this is FICO, and then this is the version 3.0, 4.0, whatnot. So like I said before, they both generally operate in the same range, 300 to 850. Whereas FICO creates bureau-specific scoring models. Remember I said if you pull a FICO from Equifax or TransUnion, they might be different, they might be the same. Vantage creates a single model that can be used with a credit report from any of the three. And the latest version is known as Vantage 4.0. And these are the factors, the most recent version that are used. So you can see payment history, the age, mix of credit. They look at new credit. They also look at balance. So what's different about the Vantage score is they combine age and mix of credit. As you can see that 20%, they combine that into a single category. And in addition to credit utilization, which is 30% of your score with the FICO, they consider a credit card and loan balances separately. So utilization, meaning how much you've used, and then balance of your loans, they consider those two separate categories. You can get free versions. You can get a free Vantage score through a number of providers. Vantage scores are usually offered through Credit Karma, Credit Sesame, Capital One has something called CreditWise. There's lots of ways to get a free Vantage score. There's also a lot of ways to get a free FICO score. Check with your credit card issuers, your banks, your credit unions. And again, you can also check Credit Sesame or Credit Karma. So this is just like a top line view of how they're different, the Vantage and the FICO. I think what's important to know here is paying on time is still really super important. And when you're looking at a Vantage score versus a FICO score, think of a Vantage score as like an educational score. In other words, it doesn't mean that it's exactly what lenders would be pulling, because 90% of top lenders in the US are using FICO, but it gives you a gauge. It gives you an idea of, you're probably going to be pretty close if you pull a Vantage score. So if you've got a good rating with a Vantage score, you're mostly going to have a good rating in other models. In other words, free scores, even though they're considered educational scores, are still important, and they're a good gauge. And there are a lot of organizations that use the Vantage score. To name a few, the US Department of Housing and Urban Development, the Federal Housing Administration uses the Vantage score, and also National Credit Union Administration. They all use the Vantage score. So understand that even though with the FICO score, the other thing to remember, even though it's 90% of the top lenders using it, there are still more than 60 different types of scoring models within the FICO. So one FICO scoring model, remember how I said, depending which bank or creditor is using it, they may not necessarily come up with the same exact number. So if you see a huge disparity, say you pull the Vantage score or you pulled a FICO score from Equifax and you go to a bank and they have a much lower number, then this is going to be a red flag, and you're going to want to inquire about, did you pull it from TransUnion? Did you pull it from, Experian, something different? Maybe there's something on that credit report that you haven't checked that's negatively affecting your credit score. So that would be a red flag for you to look into. So I'm going to let Alicia take over, and she's going to take you through some strategies, which is our second objective, strategies how to boost your credit score. Alicia?
All righty, so now that we've talked about what factors are taken into consideration when coming up with your credit score, now we're going to, like Vincenza mentioned, talk about some strategies to boost your credit score. So the first place that you should go when you're trying to improve your credit score is your credit report, so that you can know where you're starting and have a clear and complete picture of your financial standing with creditors. It won't show you your score on there, but you will be able to see what things you're doing that are positive that you need to continue doing so that it will continue increasing. And then also what negative things are on your credit reports so that you can take care of those things. And then also, like what we talked about in some of our other webinars, it's so important to be checking for errors when you check your credit reports. So if you see any errors, there's usually going to be a small section on your credit report that gives the contact information for the credit bureau and a little bit of instruction as to how to dispute any errors that you find. And it's really important to do that because you have the right to have an accurate credit report and credit score. And as you get those errors disputed, the sooner you do, the better, because it can increase your credit score, especially if it's any negative items. I mean, if it was like a positive thing on there, like a positive account that's in good standing, it may not affect your credit score as much in a positive way. But oftentimes you see errors when it's with negative things. And they make so many errors with credit reports. So it's so important to be checking for errors on your credit report so you can take care of them. So the next one we're going to talk a little about is, like what Vincenza mentioned, that your credit utilization ratio has a big impact on your credit score. And so if you are wanting to improve it, it's so important to keep your utilization ratio low and aim to keep it between 10 and 30% of your credit limit. And so this is whether you have credit cards or a line of credit. So any type of accounts that has a set limit on there, you want to try to only use about 10% of that limit, possibly up to 30%. But if you keep it closer to 10, you'll see an even greater boost. And like what we've talked about, this is the second most influential impact on both the FICO and the Vantage scores. So this is a great area to start. And we'll be giving some tips later on about keeping your utilization ratio down as well. And then also pay any outstanding balances in full. This is so important. Like Vincenza mentioned with the poll, this is one of those common myths that people think that carrying a balance is going to improve their credit score, but really it's not helping your credit score. Especially if you are behind on making the minimum payments, but also just in general, if you are carrying a balance, then creditors will see that it's a little bit risky to lend to you because you're not able to make those payments in full each month. And so once you do get any outstanding balances paid in full, the lender will update the accounts to say that it has been paid in full in the status part of your credit report. And it will reflect more favorably on your credit score than having a balance there. And this is so important to do. A lot of times, so I have a personal story with this. So my husband, he recently got one of his debts paid off. And when he got a letter in the mail saying that the debt was paid off, it was one that he had previously been behind on making the payments for. When he got a letter in the mail saying that it was paid off in full, there's some instructions on there that said, hey, make a copy of this and send it to your credit bureaus so that you can make sure that it's reflected accurately on your credit reports so that it can help your credit score out. And so that's something that a lot of people just assume that it's going to be taken care of, but it's so important to be proactive and just make for sure that it is being accurately reflected on your credit reports. Okay, the next one is going to be if you can pay your balance off every month, then pay it before the statement is even generated. And it will give you an extra boost to your score. By the time your statement is generated, you will have a zero balance, and this is what will get reported to the credit bureaus. And so they'll see that you have a low credit utilization ratio, which, like what we've been talking about, is going to be a positive impact on your score. And then pay your credit card debt every time you get paid. And so this again is another tip to help keep your utilization ratio lower, because then you're paying off the balance for, say, half of the month each time you get paid. So then your utilization ratio and your balance is always lower than if you just waited until the end of the month. And then our last tip is going to be to increase your credit limits on your existing accounts so that you can help keep your credit utilization ratio lower. And this is something where, like what we talk about a lot around here, it is so important to know yourself when doing this and know your money habits and your money habitude, we'll say, because this can be beneficial for some people to do, but then for other people, you may know, oh, now my limit for my card is $5,000 instead of $1,000. So now I can charge that much on my card, and then it'll be that much harder to pay it off in full. So only do this one if you know that it won't be a temptation that you'll succumb to. Because there are a lot of people out there that will keep that temptation in the back of their mind, and they'll be like, oh, but I have this emergency, or now it means that I can just charge some more on it. And we don't want you to do that.
That's a great point, Alicia.
You'll never get it paid off.
That's a really great point. You have to know what your personal limits are. And just to put out there that a lot of times, if you're showing good behavior, I'm calling it good behavior, like your credit report is your report card. If they increase your credit limit and you're not comfortable with that, you can always just call them and say, hey, no, I want to keep my credit limit at what it was. So you always have that control to say, no, I don't want $5,000. I'm fine with $1,000. I do that personally. Just basically, I just don't want that temptation, and I just don't want that liability hanging out there. But it's a choice that you can make, even if they do automatically increase your credit limit.
Right. Thank you for bringing that up, Vincenza. So now we've talked about some different ways to help boost your credit score. These are some fairly simple ways that you guys can each pick one or two that resonated with you. They can help improve your credit score. Now we're going to talk about a little bit more of why it's important to improve your credit score and some areas in your financial life that you'll see some impacts of your credit score. Because the financial decisions that you make have a long-term effect, not only on your financial matters, but also on your credit score. And so that can go for good or for bad. So good money management and credit management leads to higher credit scores and can lower your costs to borrow. And then living within your means, using debt wisely and paying all your bills, including your credit card minimum payments at least on time every single month, are some really smart and wise financial moves and habits to be in. Not only just for a one-time thing, but we want you guys to strive to make those habits. They help improve your credit score and reduce the amount that you pay for the money that you borrow, which can really add up in the long run and help you to be more successful in reaching your goals. And having more money in your pocket to put towards savings, or investing, or just paying for any other of your financial goals that you have. And so it's your everyday decisions that really add up in the long run. And so here are just a few areas that we're going to be talking about. So the first one, like Vincenza mentioned in one of her examples at the beginning, is purchasing a home. This one is so important, especially right now when a lot of people are trying to get into homes. If you have too much debt, that can really affect your ability to qualify for a mortgage, because your debt to income ratio is too high, which means that you have too high of a portion of your income going towards your debt payments, that the lenders are going to be like, oh, it doesn't look like you'll have enough income each month to afford to take on more debt with a mortgage. So that's one area. And then also, there are different, we'll talk a little bit more about this, but there are different mortgage types that you have to have a minimum credit score to be able to qualify for. And so it can kind of direct or limit you in your options that you have with purchasing a house, if you have a lower credit score compared to a higher one. And then the next one is interest rates and on loans and credit cards. So if you have a poor credit score, because you're managing your debt irresponsibly, or if you're carrying a debt load that is too high, it can affect your ability to get competitive rates for borrowing money in the future, including with a mortgage, like what we mentioned. But overall, especially with credit cards, is where you see it a lot. Then you'll have a higher interest rate for when you do carry a balance and don't pay that balance off in full each month. The next one is to land and keep a job. This one is one that a lot of people don't think about, but for security reasons and the sensitive nature of some businesses, some companies will not hire people that have a poor credit history. And like we'll talk about with a few of these different ones, that as they see that you're responsible in one area of your life and trustworthy, then they can kind of use that as a way to judge your character a little bit, as far as like your trustworthiness and ability to be responsible with information that you are given. And then the next one is to rent an apartment in your name and not have to have somebody co-sign with you. This one is also another really popular one that people are seeing the effects of it right now. Landlords want to be sure that tenants are going to be able to pay their rent and pay it on time. So if they see that you have a good history of making your payments on time for your other financial obligations, they will take that as a good sign that you are going to be able to continue doing that with rent. And so this one has become so much more common of either a pro or a con. For a lot of people following the pandemic, as we're still kind of in it and seeing the effects of it, and the moratorium that they saw, because landlords had so many people that weren't able to make their payments each month, then they're kind of cracking down on this one, we'll say, of using credit scores to determine who they're going to rent to, because they don't want to find themselves in that situation. That's something that I've heard a lot of people out there, that in some groups that I'm a part of, and then also just like in financial counseling, there's so many people that are like, where can I go to rent a place where I don't need such a high credit score? Because I just have like a lower one, or kind of average, like below 700. And so it's definitely affecting the places that people are able to live right now, whether it's for a house or for renting. And then also with refinancing, right now, interest rates are super low compared to historically. And so someone that has a poor credit history and score will not likely be able to qualify for refinancing, because that is going to just be seen by the lenders as negative, that you aren't going to be able to continue to make those payments on time. And then if you choose to finance a car that you purchase, it can be difficult to finance. Even if you do get financing, you will see much higher interest rates compared to someone that has good credit. And this is one where I have a personal experience about it. So I think it was back in November, so a few months ago, my husband and I, we were shopping around for a car, and we went to this used car place, and the car was going to be about $9,000 when everything was said and done, which was a little more than I had to pay for it in cash outright. And so then we got talking about financing options. And because I don't have a credit history established from having other loans, and especially with cars, they saw me as a new buyer, is what they called it. And they told me that my interest rate, if I were to refund, or if I was going to finance a car, was going to be 8%. It was going to be between 8 and 9%, depending on where we financed it with. But my mom, 3 months previously, she has a credit score that's in the high 700s, or about 800. She financed a car that she purchased and only had to pay, I think it was like a 2 or 2.5% interest rate. So 8 to 9% like blew my mind. I was like, oh, wow. I guess that just goes to show how important having that history built up in a positive way can affect it, because that's a pretty big difference of 6%, especially over a few years that it would take to pay that off. And then also with getting a cell phone, you may have to put down either a larger deposit if you have poor credit, or pay higher rates for your service, just because you are seen again as a little bit riskier. And then also same kind of thing with getting utility accounts set up at a new place that you move into, whether it's renting or buying. You may either have to put down a larger deposit or pay an extra fee up front if they see that you have a poor credit history. And then also paying for insurance. So this is your premium rates for your insurance. So how much you pay each month or each year in total can be affected either positively or negatively by your credit score. And then, because again, if they see that you are responsible in one area of your life, they see that you are likely to be responsible in your driving habits and being safer if you are more responsible with your finances. And then also the last one is that if you have good credit management overall, you will be able to increase the savings that you have, or the money available to save, and invest more. Having a low credit score can mean that your debts are a lot more than your income is, which can make it nearly impossible to pay your outstanding payments on time, or even get your debts paid off. At least very quickly, we'll say. And so this can put you in more debt and get you into kind of a vicious cycle of just continually having debts that you're paying off, especially as that interest tax on, especially with credit cards where you see it oftentimes around 15, 20, or even 25%. That can really add up and keep you in that cycle. And that's not much less money that you have to put towards your savings, short term and long term. And it ultimately affects your ability to save money for your future self, which is so important as we talk about around here, whether it's to save for emergencies so that you don't have to go into more debt, or if it's just for your future self, for your retirement or your longer term goals. And without adequate savings, it can severely impact your financial future and cause even more stress that you have around thinking about the future and the life that you want to have for yourself then. And so it's important for your financial stability to be able to save money, at least a little bit aside each month for emergencies. So you don't have to continually digging that hole even bigger of debt that you're using. And so ultimately, your credit score is a powerful number that can affect your life in so many ways and your future as well. And in ways that you may not traditionally think about or hear about. Like what we see, we've got about 10 different ways right here that it affects your life, both right now and your future self as well. And so it's so important to protect and build your credit. It's more important now than ever before because there are so many different areas. And how you handle your finances can make all the difference in determining your credit score. And we're hoping that you've seen that there are ways that you can control your credit score. Simple ways, and that your overall habits each day make an impact. And so now Vincenza's going to kind of summarize for us what we've talked about.
Thank you, Lisa. So, you're more in control of your credit score than you think, right? And so that's what the objective of this webinar was, just to make you understand what's really affecting your credit score. It doesn't have to be a guessing game. So making sure that it's important that you understand the factors that make up your credit score, which is what we reviewed. We talked about some strategies to help boost your credit score, and reviewing and monitoring your credit are super important. Not just for your credit score, but identity theft is something else that is also part of checking your credit reports and making sure. So if you see a big disparity, or you're used to having a good credit score and all of a sudden you check it and it drops a lot, that could be a red flag. So it's really important to continuously monitor your credit. And you can pull your credit reports for free at www.annualcreditreport.com. Normally, you can do that once a year for free from each of the credit reporting agencies. But since the pandemic, the credit bureaus are allowing you to check your credit once a week for free. So check it as often as you want. You can also check your credit score, which comes from your credit report. You may or may not be able to get your score free, but getting your report is federally mandated that it has to be provided for free at least once a year. And until April of next year, you can get it for free, not just once a year, but once a week. That's also really important that you keep your spending in check, pay your debts on time. It's very easy, been there, done that, to get caught in this vicious cycle of, I can make payments on that, I can make payments on that. I had an emergency, I don't have any savings, I'm gonna put that on the credit card. It doesn't happen typically overnight. So it's about keeping your spending in check, having a budget, making sure that your obligations are obligations that are payments that you can make, and not getting yourself overwhelmed. So just doing these things are super important to mastering, the direction that your credit score is going. So our challenge to you is go to annual credit report. That's the website I mentioned just a minute ago, annualcreditreport.com. That's the one that's federally mandated for free. And if you haven't checked your credit in a few months, I encourage you to pull all three and just go over them and make sure everything that is on there is correct and that you recognize. And if not, you contact the credit reporting agency either through their website or on the phone, and you start a formal dispute process to get that corrected. I recently did that with misspellings of my name, which may or may not be a big deal. Maybe somebody was just made a clerical error, or somebody was attempting to use my credit fraudulently. So I just thought it's better to just have it corrected and keep my credit report clean. So we encourage you to do that as your challenge. And then also, once you pull your credit report, we encourage you to get your credit score and finding ways to get that for free. From one of the resources that we mentioned in today's webinar, we will also be providing a follow-up email for those of you that registered or attended today's webinar that will have links for these resources that we spoke of here today. So if you're interested in a deeper dive into personal finances, we encourage you to go and take our self-directed, self-paced PowerPay Money Master. It's an online course which you can find at powerpay.org. If you're a Utah resident, we encourage you to apply for a fee waiver. And right there, when you go to that website, you'll see where you can click for a fee waiver. So we encourage you to do that. Also, if you're a Utah resident, we would love to host a class in your community. We request at least 8 people. You bring the people, we bring the resources, we teach the material. Use this link at finance.usc.edu/EFW, and there'll be a section there where you can request a class, and that's at no cost to you. We'd love to hear your feedback. If you could please scan this QR code or go to this website and complete our evaluation survey. We are required to report our work. This webinar is brought to you by grant funding. And we would love to be able to share what you're learning and what you plan to do as a result of what you are learning from our classes. And we always want to improve our courses. We read the feedback and we want to do what we can to improve them. So if you take the survey, it's really quick. It's a 2-minute survey. You'll be entered into a drawing for some really cool swag. And the more times you enter, the more times you have. If you attend all of our webinars, our weekly webinars, if you attended all 4, for example, in the month of August, you would be entered 4 times into the drawing. If you're not already following us, please join us on the blog at utahmoneymoms.com. We put a lot of great materials on there, a lot of tips on budgeting, about credit, about debt, about being financially organized. We here are contributing editors to Utah Money Moms, so we're always creating new content. Follow us at Utah Money Moms. We're on Facebook, we're on Instagram. And if you wanted to register for webinars in the future, it's that same website where you probably registered for this webinar, and that's at finance.usu.edu/empowering financial wellness. Thank you for joining us today. We hope to see you again at one of our future webinars. Have a great rest of your day.